Welcome back to the Dividend Diplomats YouTube channel. Got your boys here, Lanny Burt, the Dividend Diplomat. Today we are going to cover a stock that has been beaten down so far. It's down 15% in 2023. You've been asking about this. You've been leaving comments about this company in our other videos, so it's finally time to cover them and see if they are an undervalued dividend growth stock to buy right now.
You guys wanted it. We bring it. Smash that subscribe button. Give this video a thumbs up. We're almost at 18,000 subscribers, trying to get to the 20,000 by the end of the year, trying to help you on your journey to financial freedom by buying and looking at undervalued dividend stocks, sharing with you what we're buying, what we're watching, and analyzing as many stocks as we can to hopefully help you see if it's a good fit for your stock portfolio.
So let's talk here. The company we're going to talk today about is Bristol Myers Squibb, ticker symbol BMY. We've talked a lot on this channel about Pfizer. We talked a lot about what I'm trying to think who else. Johnson & Johnson now is in here. We talked so much about Johnson & Johnson and the continuing company. This one always comes up as a, hey, you should also check out BMY. That's one of the big tickers that we always continue to see. They just released earnings. They just got crushed. So you know what? The time is to talk about them right now.
Yeah, pharmaceutical has not performed well this year. I mean, you name it. Pfizer getting crushed. AbbVie was getting crushed for a moment in time. Other healthcare providers getting pummeled. Bristol Myers Squibb is kind of in the same boat because their stock's down about 16% this year, and they're down over the last 52-week stretch as well. And rightfully so, because Bert, similar to other companies, how did that earnings release look like? It looked
terrible.
It looked like dogs.
Yeah, pretty much like the stuff that you just want to put in the bag and throw out in your front yard there. But it's
all light it on fire on your neighbor's front step.
That's true. Will they be putting this on Pfizer's steps? Who knows? But all right, so what happened?
It's one of them flaming bags again, Bert.
Sales were down 6%. The revenue is still, it's still 11.2 billion. So it's not as if it's a small amount, but it's still down. US revenues were down 5% too. I think the big piece of it was one of their major drugs was not performing well. And then, like we saw so much with AbbVie, so much with Humira, it's facing pressure from generics that are just coming after the biggest in Bristol's portfolio. I believe it's Revlimid. That's my guess for how to pronounce it. I'll take a golf clap. It looks about right, but so let me know if you can pronounce it. But it's always a fear for these pharmaceutical companies when one of their top producing drugs runs out, hits the patent cliff, and then someone else comes after it. That's why they put so much effort into developing. So much money goes into producing and finding that next one that they can enjoy that massive period where they are the exclusive maker of that drug.
Yeah, I mean, gross margin decreased, but all the new revenue from the new products had a nice increase of about 75%, or 79% actually. So their new drugs are performing well, but it's just not enough to hopefully make up that gap from their lower performing historical pharmaceuticals.
No, and there were two other big pieces that came out of this earnings release that were interesting. Management announced a $4 billion accelerated share repurchase plan. So
stock is cheap.
Yeah, stock is cheap in management's eyes, and that's one of the reasons why we're continuing to look at it right now, and so many of you other ones are out there. Management thinks it's cheap. Is it worth us buying in our portfolio too? It's a great question. $4 billion is not a small amount of money. The other one is the thing you don't want to see, though, lowered guidance. That continues to hit many other companies in here. Revenue down from where it was. They're now expecting a smaller amount of revenue. And earnings are now they're now expecting a smaller one, a small double-digit decline. So only 735 to 765 earnings per share. So not the best news. You're continuing to see compression, and it doesn't sound like management thinks there's much relief coming in the second half of 2023.
The year of compression, guys. And we're going to look at BMY through the DD stock screener. You guys know it by now. We'll look at the price to earnings ratio less than the S&P 500 and compare them as well to their competitors. We'll look at the dividend payout ratio, hopefully less than 60%. We'll look at dividend growth history of growing those dividends. And then as a cherry on the top, as an extra little bonus metric, we will look at the yield because the yield is what is going to pay you, brother.
Yeah, so what we're going to do is we're going to run them through, and then we're just going to share Pfizer's metrics. We both own Pfizer, and it's one we've nibbled at over the last few years. So we're going to see how does BMY compare to Pfizer, each one of these two.
Let's do it. Let's do it, brother.
So the first one, these are prices as of Friday, August 11th. So keep that in mind. BMI 6123, earnings per share 756. That's a PE ratio of 8.10, so a single digit PE ratio. Pfizer, how does it compare? Pfizer's PE ratio at the moment is 10.89, so BMY is at a much lower valuation multiple compared to Pfizer.
Yeah. Let's look at the dividend payout ratio. Right now, BMY pays, right now $2.28 over the course of the year. Obviously, divide the 228 by 4 over the quarters. Pretty low payout ratio at about 30%. So even below the 40% like we typically see, relatively safe dividend for sure. Definitely room to continue to grow that dividend by a handsome amount. Comparing to Pfizer, Pfizer's a little higher. Pfizer's at about 50% right now.
Oh, interesting. So perfect payout ratio for Pfizer. So nothing too concerning for either one of those. Let's look at the dividend growth. Their 5-year dividend growth rate for Bristol is 7.19%. They've increased that dividend for 13 plus consecutive years. Although their recent dividend growth has been slower, I've been seeing what the 1 cent every quarter is typically what you're seeing. So it's not high right now. Looks like they're continuing to put that money back into the business to keep developing that new drug pipeline. And how does that compare to Pfizer, Lanny?
Well, Pfizer's doing the same thing, right? The little 1 cent nudge.
Yeah.
Its 5-year average is about 5%, but it's actually a lot lower than that right now, about under 3%, technically.
Yeah. So let's look at the yield. Bristol BMY's yield is 3.72%. Pfizer's yield is 4.55%. So BMY has a cheaper yield compared to Pfizer.
Well, guys, so that's both dividend yields right there. Pfizer obviously offering a premium in terms of yield to make up for maybe the lower dividend growth. Both stocks down a ton. Pfizer's down 30% this year. BMY's down 15% plus this year. So again, both have been hit hard.
Yeah.
So we'll show both metrics. BMY has a better PE, a better payout ratio, possibly a better growth rate. Pfizer really just has a better dividend yield right now.
Yeah. So my question is, am I buying Bristol? Let's start right there. No, I'm not buying them. I have enough pharmaceutical elsewhere. I don't really want to build a new pharmaceutical position. And overall, too, I can see why it's cheaper compared to Pfizer. You read that earnings release, there's not a ton of very positive news going on right there outside of the increased sales for some of their new pipeline, which is great. But you can get why they might be a cheaper valuation compared to some in those sectors. So it seems like the market has it right from a price to earnings perspective.
Yeah, I mean, obviously, with pharmaceuticals, the big fear is when patents start expiring and generics flood the market. I know that there is a fear across the whole healthcare industry with Amazon and a lot of the prescriptions you might be able to fill with extremely low price generics. Something to always be on the lookout for that's really punishing the arena right now. But hey, you know, I always think it's a fun time to research and analyze stocks in industries that aren't performing well, such as healthcare right now. So there's a lot of good value here.
Yeah.
If you own BMY, feel free to start adding.
Yeah.
Similar to what Bert owns Pfizer, I own Pfizer. So we've been adding shares. I hit 200 shares on Pfizer. But if you were to ask me, am I buying Bristol Myers? I'm not. I just don't want another position like Bert said.
Yeah, I agree. I leave this thinking, hey, Pfizer is also looking cheap as well, so I might add a few more to Pfizer. That's kind of where I'm at leaving this. So you said it best, Lanny. So everyone, let us know what you think of BMY right now. Are you buying? Would you initiate a new position in this, or would you prefer a completely different pharmaceutical company? Let us know down there. And if you haven't already, subscribe to the channel. Give this video a thumbs up. And remember, if you're not with us, you're against us. Jack.
Get out of here, guys, because that was Bert the Hurt and Lanny from the Dividend Diplomats. Over and out.